Okay, let's start. Good evening, everyone. Hope you are preparing for your exams. You are revising on all your courses. So tonight, let's quickly look at ratio analysis, which is a um, common area in your exam that will definitely see in your exam papers. And I will just go straight to what you need to know for your exams, of course, in detail. So the first thing I would mention is not the definition of ratios, no. It's basically the categories of ratios that we have. And these categories of ratios would expose you to exactly what we use ratio analysis for. The first category of ratio is profitability ratios. Profitability ratios. The second category that we're going to look at efficiency ratios. Also, there is liquidity ratios. Also, there is solvency or debt ratios. And there is investors ratios. These are the 5 categories of ratios that we have. And for the profitability ratios, these ratios will help identify whether an entity is profitable, that is, it shows how well a company uses its capital or resources to generate profits. And the key profitability ratios for your exams are: there is the return on capital employed. That's the first profitability ratios. Return on capital employed. Oh, someone said you can't see my board.
Yes, sir. I can't see it, sir. It's not on.
I can see
it
it.
is
We
on.
can see it, oh. We can see it. Maybe you should
They
reload. It's clear.
should check your.
Oh,
We are number 1, return on capital employed. It's clear. That's it.
so this strange. This has never happened before. That's some.
Okay, maybe I should go out and come back, but I will miss the explanation.
Okay, just hold on a little. Just hold on. Let me do something.
Okay, all right, sir.
Can you now see it?
It is on.
It's on now, Abi.
Yes, sir. It is, sir.
Okay. How about Mr. I think Mr. Oseni also mentioned the consent. Okay, let us proceed. So the key profitability ratios that you need to be aware of for your exams, there is return on capital employed, there is gross profit margin, there is operating profit margin. We have there is cost of sales ratios. There is cost of sales ratios. Yeah, which one again? These are the major ones that you need to be aware of for your exams. And the first one, I don't just want to give you the unnecessary, there are a lot more, but now I'm very exam focused. The first one, which is return on capital employed. You see, this ratio measures the ability or the proportion of, in fact, let me make it simpler. It measures the amount of profits. Let me keep it that simple for you. It measures the amount of profits that is made on an entity's capital. That is made on an entity's capital. So it is calculated as below. So it's calculated as profit from operations. And when I say profit from operations, I mean PBIT, which is profit before interest and tax, or it's also called operating profit. You see, this divided by your capital employed. Now, in some questions, they would tell you what the capital is. In some, they will not. But if you're using your profit as profit from operations, then the capital must be capital plus debt. Let me call it fixed interest debt. Fixed interest debt, meaning both short-term and long-term, except the examiner states otherwise. But the reality is that what this ratio looks at is you want to know how much profit are you making from the capital they gave you. And you know that when you look at statement of profit or loss, there are different levels of capital there. There is gross profit, there is profit from operations, there is PBT, there is PAT. You see, this profit from operations is the profit before you paid interest. That is why you're having debts as part of the capital, because they are part of the people that owns these profits. If the profit I was using, if I had used a profit for the year, or I decide to, or what we call PAT, my capital employed must be equity. It must be equity. If you use PAT, or the examiner says, for the purposes of returns on capital employed, use profit as PAT, is a trap for you. If you go and use your capital employed as equity plus fixed interest or plus debt, you are wrong. The capital you must use is equity. And that is why, if you remember, when we did earnings per share over the weekend, it was this. We used weighted average number of ordinary shares. It was focused on equity. So you need to be very careful when it comes to returns on capital employed. If, for example, I've seen a question where the examiner will tell you that use capital employed as equity plus debt. If they tell you that, and you go ahead and use either PAT or PBT as your profit, you are wrong, go. If the examiner tells you that the capital employed should be seen as equity plus debt, you must, as a matter of compulsion, you must use the profit as profit from operations. It has to be PBIT. And that's the technicality I need you to note here when it comes to return on capital employed. And it measures the amount of profit that is made on an entity's capital. And of course, the higher, the better. The higher this ratio, the better. A company that is doing 30% is better than a company that is doing 10%. It is better. Though there are disadvantages to these ratios anyways, because with the way this ratios is calculated, there's no way you can use this ratio to distinguish between a small and a big company, because these ratios are usually computed in percentage. They will multiply it. So a small company that is making small profit and his capital employed is him to be parading a ROCE of 25%, and a big company is also doing 25%. They would think that they are the same. So those are, and that's common to all ratios anyways. Okay, so that's returns on capital employed. Now, the second one is your gross profit margin. This one is quite straightforward. So this ratio measures the amount of gross profit that is made on every sales, and it is calculated as below. It's calculated as gross profits all upon sales. It's calculated as gross profit all upon sales, of course, multiplied by 100/1. So, of course, the higher the better for this ratio as well. And very similar to that is cost of sales ratio. Cost of sales ratio is similar to gross profit in the sense that this ratio measures the amount of cost of sales that is incurred on every sales, and it is calculated as below. Is cost of sales over sales times 100/1. That's the cost of sales ratio. And there is also the operating profit margin. And this ratio measures the amount of operating profit that is generated on every sales, and it is calculated as below. That's my operating profit. Don't forget, operating profit is PBIT divided by sales multiplied by 100. So if the examiner is funny and also gives you net profit margin, okay, if they come up with net profit margin, no problem. You just use that. It's the same formula, but it's now you will use profit for the year for that divided by sales times 100. All right. So when we solve questions, you will see the differences between this and how they are analyzed, and very straightforward. I mean, you will see that the differences between gross profit margin and operating profit margin will be more of the overheads of the company. So a company that is making a low operating profit margin, we can attribute that to their admin and distribution expenses being too high. And also, gross profit margin can also be explained by our cost of sales ratio, because when the cost of scale of sales ratio is like 70%, meaning the cost of sales you incur on every sales is 70%. So that means you're going to expect that the gross profit will be 30%. So if you can reduce your cost of sales ratio, that would seriously impact your gross profit ratio. Now, the next one is efficiency ratios. Efficiency ratio. So this majorly focuses on efficiency in the utilization of resources, right? So see, this ratio focus on how efficient an entity manages its resources, particularly its working capital. How well are you managing it? Your working capital. So if you want to have an understanding of that, come to efficiency ratio. And the ratios, the key ratios here are, first, I will deal with asset turnover. Is more of efficiency ratio. I'll deal with asset turnover. I will deal with trade payables in this. I will deal with trade receivables in this. I will deal with inventory in this. So these are the key efficiency ratios. There could be more, but these are the key ones for your exam. So the first one is asset turnover. So this ratio measures the number of times an entity converts its assets to sales. Okay, how efficient are you using your assets to generate sales? So it shows how efficient an entity uses its assets to generate sales. How efficient are you using it? And it is computed as below. It's computed as, you have your sales over total assets. And you know that your total asset is your current assets plus your non-current assets. So this will give you the number of times an entity uses its assets to generate sales. The second one is trade payables in days. trade payables in days. So this ratio measures the number of days it takes an entity to pay its suppliers. An increasing ratio, an increasing trade payables in days shows that an entity might be using suppliers' funds to support its working capital, which might be a signal for liquidity issues. You see, this comment already negates the assumption that the higher trade payables in days, the better. That if you are stretching how long it takes you to pay your suppliers, that's good. That you can use that money to do something else and all of that. No, that's a very blanket interpretation and is very dangerous. So as a finance person, you need to look deeper that why are you delaying your suppliers' money? Because ordinarily a business person, as soon as you sell and you collect money and you have the money, you want to pay your supplier so that you can do another business, so that I can give you another goods. Except if it's just a one-off transaction you did with that supplier. But if that is your core line of operations, it's not good to extend or delay your supplier's money. However, it is necessary to negotiate a favorable credit period, with your supplier, and an entity must ensure that it does not exceed these credit terms. So you don't exceed it. So maybe in that wise, we can say that, okay, if trade payables in days means the number of days your supplier gives you to pay, then an higher one is good for you. Meaning you are going to take your time before you pay. And both of you has mutually agreed that pay within 13 days. But don't exceed that period. Don't exceed it. So we don't ordinarily translate or interpret an increasing payables in days as that is good for the company. No, it could be a signal for the liquidity issue and other underlying issues with the company. So we need to look further. We need to actually look further. So for me, when I want to interpret this, if I'm seeing it increasing, I would compare this with the liquidity ratio. If the liquidity ratio also is not good, I will tell the examiner that the delay is as a result of because the company does not have money. Why these trade payables in this is increasing is because they don't have money. And that is reflected in their liquidity ratios. That's how I'm going to interpret it. But if the trade payables is increasing, and I can see that this company liquidity ratios are good, then I can say that this company has been able to negotiate an extended credit term with its suppliers. And that can explain why their trade payables in days is increasing. And considering the fact that they have strong liquidity ratio. They have no reason to delay suppliers' funds. Yeah. The next one is trade receivables in days. Sorry. And this is calculated as below. Still talking about trade payables in days. So we usually calculate it as trade payables over, you can either use credit purchases. I bet you won't find it in the question. So just use your cost of sales straight on, multiplied by 365 days. If you don't put 365 multiplied by 365 days, your ratio will be wrong. But trade receivable in days, these ratios measures the number of days. Number of days it takes an entity to collect its money from its customers. Of course, the lower the better. Collect your money earlier. And this is computed or calculated as below. It's calculated as trade receivables all upon credit sales. See, you will not see credit sales in the question, except, I mean, they just want to give you, but usually you won't find it. You just use your sales. If you don't find, just use your sales as it is. Don't start looking for credit sales up and down. Then we have inventory in days. And this ratio measures the number of days it takes to sell inventory to customers. So how many days does it take you before you sell your goods to the customer? And this is calculated as below. It's calculated as your closing inventory. Sometimes you can use your average inventory depending. I usually use my closing all upon, use your cost of sales straight on. Of course, multiplied by 365 days. So from this efficiency ratio, okay, note that the efficiency ratios computed above can help determine an entity's operating cycle. So it can help determine an entity's operating cycle, which shows how long it takes an entity to start and end a transaction. So how long does it take you to start and end? What's the duration? And this is calculated as below. It's calculated as trade receivables in days. You add inventory in days. You deduct trade payables in this, when you do these maths, whatever you get is what we call operating cycle. So the shorter the operating cycle, the better. Better for the entity, because it means that it generates cash flows from every transaction very quickly, which is good, that means it's efficient. It converts inventory to receivables, pay payables, and move on. However, an elongated operating cycle is usually a symptom of overtrading. So when you see a company that has an elongated operating cycle, that company is overtrading. That is exactly what we are going to imply, that you're overtrading when it's on operating cycle is elongated. So yeah, sometimes they don't give sales or cost of sales. Of course, they will give you that. How will they give you sales and cost of sales? They will definitely give you that. So you see, when we say overtrading is when an entity is doing too much with very little resources. Is doing too much with very little resources. So in the sense that it has very little capital, it has high level of inventory, which is funded by high level of bank overdrafts, loans, and for it to have high level of this, it has high investment in fixed assets, PP, just so that it can. Now, it's not desperate to sell. It will now has high level of sales that is not backed up by liquidity, by cash. So you now find out that this company has high level of trade receivables. And of course, because it doesn't have money, it would definitely be owing its suppliers. You have high level of trade payables. And here, of course, the only thing it has low of is cash. It doesn't have cash. That's the only thing is low. Its cash position. Its cash position is negative. It has a negative cash position. So all these are symptoms of overtrading. The next ratio is liquidity ratios. liquidity ratios. Now, the key ratios here, of course, liquidity is, are you liquid? Do you have money to settle your liabilities? I mean, this ratio shows the ability of an entity to settle its payables with its liquid assets. So the key ratios here are, so the key liquidity ratios, we have current ratio, we have acid test ratio. Acid test ratio. What's another name for acid test ratio? Quick ratio. We have even the cash. We have cash ratio as well. And there are other ones, but these are the key ones for your exams. And what's current ratio looking at? So here, this ratio measures the ability of an entity to settle its short-term liabilities with its short-term assets. This ratio measures the ability of an entity to settle its short-term liabilities with its short-term assets. And this ratio is calculated as below. Is current assets over what? Current liabilities. So we would expect that we're having, so an ideal ratio here is 2:1 and above. That's the ideal ratio. 2:1 and above. Your current assets should be at least times 2 of this. The second one is quick ratio. It measures the same thing. So this ratio measures the ability of an entity to settle its short-term liabilities with its highly short-term assets. Can you settle your short-term liabilities with with even the more liquid assets than the current assets? And this ratio is calculated as below. It's calculated as current assets minus inventory divided by current liabilities. Okay, so an ideal ratio here is 1:1 and above. Okay, so this ideal ratio, you have to be very careful. I won't measure based on, when I want to interpret, when I want to speak to these ratios, I won't speak to it based on this ideal ratio that I'm giving you. It would majorly, I will look at the sequencing. I will look at the previous years. Where are we coming from? right? If we are getting better, then I would hammer more on that. Or if you are better than industry, then I will emphasize more on that. Okay, this company is good because its ratio is better than that of industry. But what the take home from here is that the higher the ratio, the better. The higher the better for this company. And the best measure of liquidity ratio is cash ratio. Because this ratio measures the ability of an entity to settle its short-term liabilities with its cash and cash equivalent. You have cash to settle, so it's like cash and cash equivalents. Cash and cash equivalents divided by your current liabilities. That's what this looks at. And the next one is solvency ratio. And this ratio is sometimes called debt ratios. And it focuses on the ability of an entity to continue to operate in business into the foreseeable future, given its level of financial risk. And this financial risk is the risk that the entity might not be able to settle its fixed interest which would then result in liquidation of the entity. Financial risk can also be seen as a situation where the amount of interest payable becomes so excessive that it will significantly impact the dividend payable to the ordinary shareholders. And when the ordinary shareholders are not happy with a company, it will show in their share price. And the key ratios here are the most important one that you must always calculate is gearing ratio. There are other ones too, but this is the first one. There's gearing ratio. Another key one is interest cover. Every other one can be coined. There's one they call debt ratio, but gearing and interest cover is the key ratio for solvency. Every other one is you're just looking for names around. And when you see gearing ratio, again, this ratio measures the amount of debt in an entity's capital structure. So what's the amount of debt in your capital structure? And it is computed as below. Is debt, let me be specific, fixed interest debts. When I say fixed interest debt, I'm sure you know that these are interests that you pay fixed interest on. Like they will put percentage behind it, like they will say 10% loan notes, stuff like that. All upon fixed interest debt plus equity, of course, times 100. And interest cover this ratio measures the number of times an entity's profit from operations can cover or pay its interests. Of course, I'm sure you know that the lower this gearing ratio, the better. The lower, the better. And an ideal is 50%. As soon as it's becoming higher than 50%, becomes an issue. The financial risk is getting more. And this is calculated as below. It's calculated as profit from operation, which is profit before interest and tax. That's PBIT divided by finance cost or interest paid or payable. That will give us our interest cover. And there is debt ratio. So this debt ratio measures the proportion of an entity's assets that is financed with debts. And it is computed it's calculated as the fixed interest debt divided by total assets. Of course, multiply by 100 over 1. And the one that they don't really ask so much in the exam is this. They hardly ask it. Investors ratio, they hardly. So this is more popular for entities that are quoted or listed. And a lot of these ratios, why you will not find most of them is that there are other ratios up here that is already measuring the same thing. Just that this is more suited for companies that are listed for it's like stock market indicators, something like that's what they do majorly. like for example now, a key ratio here is earnings per share. Well, even though we have done that as a separate topic, but there's another ratio that does the same thing, which is returns on capital employed. Or you can even call it returns on equity. I told you that returns on capital employed can simply be profit after tax over equity. That's returns on equity. So ICAN can ask it, they might not ask it. What I've seen them ask around here is, what's the limitation of EPS? It's the same thing as limitation of ROCE. You can just mention more things around that. And the major limitation is the fact that it doesn't consider cash. You just consider profits. You are saying that this is the earnings per share. What's that? What if you don't have money? So earnings per share does not show anything if there's no money that is backed, that's backing it up. If it doesn't translate to cash flow, then nothing. Again, it doesn't show the relative strength or profitability of a company because it doesn't distinguish between a small and big company. A big company can have EPS of 2 naira. A small company can have EPS of 2 naira. So on the surface, it might not really help. And it can even be manipulated. Again, it's easily impacted by choices of accounting policies by company. And a lot of other limitations that it has. And other popular ratios here, we have dividend per share, we have dividend yield, we have earnings yield, we have earnings yield, we have dividend cover, we have earnings ratio, we have payout ratio, and a lot more like that. I've seen a question ask you net asset per share before. I've seen it. There's nothing special there. And they ask you net asset per share. So from the name, earnings per share, how much is attributable to each ordinary shareholders? So this is computed as below. It's computed as profit after tax minus preference dividend divided by weighted average number of ordinary shares. This gives you your EPS. We have dividend per share. This is the dividend paid divided by number of ordinary shares. We have dividend yield, which is a better measure. It measures, see, a dividend paid shows you the amount of dividend you're giving to each number of ordinary shares. Dividend yield shows you the return you're getting relative to the amount you have invested. Dividend yield shows you your actual return and is the best to measure companies on the stock market, not dividend per share. It's dividend yield because a company can be giving you 5 naira dividend per share, But to buy their shares is 10 naira. But the company is giving you 4 naira dividend. But you can get their shares for 3 naira. The one that is giving you 4 naira and getting their shares for 3 naira is better than the one that is giving you 5 naira. And to buy their shares is like 10 naira. That is what dividend yield tells you. It tells you, it puts the dividend per share. It puts it on the market price of the company. It compares it to the market price. Okay? That tells you the actual return you're getting from this company. Also, is earnings yield. Earnings is similar to dividend yield, and is earnings per share over market price. Also, is dividend cover. And dividend cover is, how many times can your earnings pay your dividend? That's earnings per share. How many times can your earnings pay your dividend? Earnings per share divided by dividend per share. And there is price earnings ratio. Price earnings ratio. This formula can be getting from the name of the ratio, price divided by earnings. Price divided by earnings. Price earnings. Earnings per share. This looks at how much the market is ready to pay for an entity's shares. How much is the market? How much are they ready to pay for an entity's earnings, not shares? How much are they ready to pay for their earnings? Okay, so when you see a company with an high P ratio, it's mostly because the market believes in this company's ability to grow, that its earnings is small relative to its valuation. It's just like a Tesla, for example, that is worth much more than a Toyota. When you compare their earnings, you would wonder that why is Tesla more valuable? It's because the market has confidence that in the next few years, that Tesla's earnings is going to multiply and to be very huge. So a lot of people are buying their shares is going up. And that's what price earnings ratio shows you. The direction of it will tell you how the market perceives this company, will tell you how much they are ready to pay. Sometimes they call this ratio earnings multiples. And there is payout ratio. This is the proportion of earnings that is payout as dividend. So it's like dividend per share over earnings per share, the proportion of earnings that is paid out as dividend. And finally is net assets per share. And this is the net asset of the company divided by number of ordinary shares. So you see, all of these ratios that we have computed, they are great, they are good. Is a good measure of profitability, is a good measure of liquidity. They are so fantastic, except the fact that You need to be very, very careful of this, right? Number one is this. See, these ratios are based on the accounting policies used by the company. The accounting policy a company uses can significantly impact their ratio. There was a question I solved for professional students, I think in case study. There's two companies that they want to buy. One company measures, they measure their assets using evaluation model. Another measures their assets using cost model. When I wanted to do my ratio, the first thing I did was to make adjustments. I had to adjust the guy that uses evaluation model. I adjusted for all the evaluation everywhere, just so that I can bring its account back to cost model. And it is only after I've done that that I can compare the two companies. Otherwise, so they are based on accounting policies used. And this can restrict the application. This can restrict our ability to use them for comparison. And also, because ratios are based on financial statements, and financial statements can be manipulated. So the financial statements can be manipulated, which will then affect the ratios. Whatever ratio you are computing, it can also be affected. Okay? The ratios can give a misleading results in a period of inflation. Where there is inflation, there are some ratios that would be inflated, like your gross profit margin, for example, because your cost of sales might be depressed or even increased when there is inflation, and it can affect a lot of your ratios, as it were. And also, some companies have seasonal results. There are some companies that their own performance, they do well at the end of the year, in the middle of the year. So depending on which period the ratios you are computing or the account you have falls into their seasonal year, where they are doing so well, the ratios will come out so good. And that does not really represent that the company is doing fantastically well and all that. And a lot of other limitations that can arise as a result of ratios. If you look at,
Completed the limitations.
sorry, what do you say? Hello?
I think she was trying to jot it down.
Now, if you look at this question, this is a very simple question. It talks about Badag PLC statement of financial position as at March 31st, 2021. They give us statement of financial position for 2 years. Let's see some key items here. They also give us statement of profit or loss for the year ended March 31st, 2021. We're now asked to discuss the profitability, gearing, and investors' stake in Badagry and recommend strategies for improving or sustaining them. So if you look at this question, the examiner didn't just tell you to compute, they actually told you to discuss. So, I mean, there are several approaches to this, and in just 10 marks. And in the 10 marks question, in the exam, you don't have, when you multiply this 10 by 1.8, right? I don't want to spend more than 18 minutes on these questions. So the best I can do for these guys is to compute 2 ratios each. 2 ratios each for each of them. Then I move on. And a lot of ways I can interpret, even if you don't compute ratio self, you can use trend analysis to speak to this. Just like it will be difficult for us to use trend for this P&L because we're not given the prior year. So first, for me to discuss, I need to compute some profitability ratios first. I would first compute. The first one I would do, which I would advise you always do, is your returns on capital employed. You see, these returns on capital employed, in some places you will see returns on assets, return on equity. I mean, this one is for your exams. This takes care of it because they measure the same thing, really. And return on capital employed is, like I told you, profit from operations, which is PBIT, divided by your capital employed, which I told you is fixed interest debts plus your equity. So I'm going to be looking at 2 years. Can't even look at 2 years. Now, I don't have that much time. So the examiner didn't give me profit from operations. So I'll just use profit for the year, 216,500. So profit for the year, 216,500 divided by, what's my capital employed? I will use equity since I'm using profits for the year, I have to use equity alone divided by 560,000. Multiply by 100. What does that give us? 216,500 divided by 560,000. That's 38.7%. Another key one that I can do is my gross profit margin, which is my gross profit divided by my what? My sales. Multiply by what? 100. What's my gross profit? It's 260,000. 260,000. What's my sales? Oh, 268. This one is 490,000. Sales is 490,000. 268. Mr. Christopher, yeah, I can see your hand. Please go ahead.
Please, I want to be clear on this uh, uh, rules, that is return on capital employed.
Okay.
Uh, you are using profit after tax, and I don't know whether it's an alternative usage. You did less finance costs. Is it allowed?
What do you want to less finance costs? Can you speak more to that?
Okay, now I used to understand that we used to use PBIT, and then over capital employed, and PBIT is not given as it is, but we have finance costs, they will have profit before tax. So I don't know. That's why I'm making this call to get a really deep explanation whether if we are using profit for the year, it's just okay like that. We should not bother ourselves whether lessen finance costs. So that we don't go and use profit for the year, we will not now let finance costs again, we should not go to invariably give us a very wrong figure. I want to be clear in this area, sir.
Okay. So which is
Because
why
I'm used to. So I don't want to be used to nonsense. Let me just get close, be clear with this, please.
okay, all right, no problem. So it's because you entered the class a little late. We have already explained that already, that you can either use profit from operations, which was the first thing I wrote before I cleaned it,
Mm.
which is PBIT. But when I looked at the PLL, I said I was not giving directly. I don't advise that you should start computing. No, you don't have that time. These ones that I'm doing, I'm even thinking I'm wasting my time because I can use trend analysis to do some interpretations, but just that it will not fly that much. But because I want to talk on the examiner says discuss. However, if you are not given profit from operations, don't stress yourself computing all that. Just go ahead and use profit for the year.
Okay.
Just ensure that the capital employed you then use
Mm.
is equity. That one is very important. Make sure you use equity.
Just equity.
Yes, equity. Because you can only use equity plus debt as capital employed if the profit you are using is profit before interest and tax, which is profit from operations. That is when the capital employed can be equity plus debt. That therefore means that if the examiner tells you in a question that you should use your capital employed as equity plus debt, it therefore means that you have to work out your profit from operations because you can only use profit from operations. In this case, now I'll be forced to work it out. And if I want to get my profit from operations, all I just need is this 18,500, which is my, no, this 26,260, 286,500. I will deduct this dividend received and add this finance cost back. That would give me my profits from operations. That will give me my profit from operations. If I do 286,500, I deduct this, I add this back. But in this case, I was not given all of that. So I have the freedom to play around. So my gross profit margin is giving me this. Then I can do net profit margin, which is net profits over sales times 100. And my net profit is my profit for the year, 216,500 over my sales, which is 490,000. What does that give us?
34.2%.
44.2%. So for my gearing, I will do gearing ratios. My gearing ratio, I will use fixed interest debts over fixed interest debts plus equity times 100. So what's my fixed interest debts? 50,000. What's my equity? 560. Wow. 50 times 560. What does that give us? That's 0.2%. That's around 8.2. And I can do interest cover, which is my yeah, which is my PBIT divided by my finance costs. And like I told you, my PBIT will simply be my 286,500 plus 5,000 minus 153,500 divided by 5,000. What will that give us? Wow, that's massive. Okay. An investor's stake. For investor's stake, I can do net asset per share, which is net assets divided by number of ordinary shares. And what's the net assets? Which is 810,000 minus 50,000 minus 200,000. Total liability is 250,000. So 810 minus 250. What's the number of ordinary shares in 2021? That's 220 divided by 0.8. 220,000 divided by the nominal value. which is 0.8. So what does this give us? What's 810 minus 250? That's 560. That's equity. What's 220 divided by 0.8? That's 275,000.
2.03.
Wow.
2.04.
Very, very good. So what's the name of this company, sir? Badag PLC. So I want to discuss, I'd say Badag PLC has a ROCE of 38.7%. 38.7%, which is, what is the cost of capital? It's just 10%, okay, which is higher than the cost of capital, or let me be specific, cost of debt of 10%, which shows that it is better to invest in Badag PLC than placing the funds in the money market, because you only get 10% in the money market, and Badag is giving you 38.7% on the capital you give to them. Additionally, the entity, sorry, somebody is writing all sorts on the board. Additionally, the entity makes a gross profit margin of 54.7%. 54.7%. Which looks impressive. That's over 50%. Which looks impressive. So considering that it's only incurs 45.3% cost of sales on every sales. Every other one is gross profit. This one is just 100 minus this. That's how I got this 40. So which looks impressive in every sale. However, the where is it? Yeah, the net profit margin. However, the net profit margin declined slightly, because it's not a great decline. Declined slightly to 44.2, which is still okay. Which is still okay. declines likely to 44.2%, and this decline will majorly account for its overheads and finance costs in between. That's why there is a decline from 54.7%, but it's still okay. It's still okay. So, from the above ratios, Badag PLC is a profitable company. As its makes impressive gross profits on every sales, and it makes very good profits on the capital employed. So it's a good company. Furthermore, the gearing ratio of how many percent? 8.2%. Wow. Also shows that the company funds its operations from equity and takes very little from its debt holders. Though, let me see whether debt is increasing year on year. It has started increasing. Though the debt has started increasing year on year, and if this trajectory should continue, its gearing ratio will continue to increase, which will then indicate a high financial risk. But that's that time, right? But as far as now is concerned, this company funds its operation from equity and takes very little. So this company is not exposed to any financial risk. I mean, 8.2%. That's good. That's good. And it also has an impressive interest cover. The entity can cover its finance costs with its profits from operations 27.6 times. 27, that's good. Finally, with a history of low gearing, it is therefore not surprising that that in the investor's stake in the company is high. Is high. The net assets per share is over 2 naira. Is over 2 naira. And net assets are majorly funded by equity funds, not so this impressive profitability, gearing, and investor stake should be sustained by Badag PLC by ensuring that it continues to manage its cost of sales, continues to reduce its overheads, it engages in marketing in order to improve sales, it continues to use equity funds for its operations in order to depress the need to pay interest, and it should continue to was it paying dividend? No, I don't know. So I cannot say it should continue to pay dividend. I don't even know whether it pays dividend or not. Okay, I've done more than what the examiner would even expect in this exam. If you look at the second question, it says Lamido Limited is a courier service company which operates in Nigeria and West Africa. Initially, Lamido Limited experienced strong growth, but in recent periods, the company has been criticized for underinvesting in non-current assets. It has been underinvesting in non-current assets. So Lamido Limited statement of financial position as at December 31st is as follows. To give us all this. Okay. I'm always focused on this. There's both long and short. You now say that other extract from Lamido Limited financial statement for the year ended is as follows. They give us all this. Say the following information is also relevant. Lamido Limited had exactly the same delivery volumes in 2002 as in 2022 as in 2021, with customers base being the same in both years. Okay. So that means that the volume of sales, the quantity of sales didn't change. So what happened to why did revenue fall? Could it be they reduced their selling price or what? Because their revenue is falling. Also, it said in October 2022, Lamido Limited had to renegotiate its operating licenses in 3 of its countries of operation. This led to increase in the fees Lamido Limited had to pay to operate in these countries. The operating licenses in 5 other countries are due to expire in December 2022, and Lamido Limited is currently negotiating with the concerned authorities of this country. Okay, so this company is trying to get a new license. He wants to renegotiate its operating licenses in 3 of his countries. And it has led to increase in fees that he had to pay to operate. So, and its operating licenses in 5 other countries are due to expire. And Lamido Limited is currently negotiating with the concerned countries. So in this particular diet, the examiner says that you should compute these ratios. And they say for calculation purposes, all loan notes should be treated as debts. All loan notes. And this is just for 6 marks. So that means you don't want to spend so much time on any wasting time on this ratio, because the major thing they want you to speak on is on the comments you're going to make on this ratio. And the first ratio we're asked to compute is operating profit margin, which is my operating profits divided by my sales. Divided by my sales. And from the question, what's my operating profits? That's the profit from operations. This is 12,300. Okay. So this is 12,300 for the first year. And what's my sales? 154,000. So they give me 2 years. I need to compute for the 2 years, 2022 and 2021. And this is 18,600 and 159. $18,600 divided by 159. Okay, so how much do we have in 2022? This is 7.99. That's like 8%. And 18,600 divided by 159,000. That's around 11.7. And the next one is return on capital employed. And since the examiner has already spoke, they didn't tell me what to use as capital employed. So, but now that you are given profit from operations, is advisable because to use your PBIT, which is profit from operations, divided by your capital employed, which is your equity plus debt. And this is 12.3. This is 18.6. So let's get our equity and debts in 2022. In 2022, my long-term debt is 136,100. My equity is 192,100. Okay, let me note that down. 192,100 plus the long-term debts plus the short-term debts. This is 19,440. Don't omit it. Examiner really doesn't want you to omit it. So having established this, in 2021, this is 44,800 plus 150,400, 44,800 plus 150,800. This is not just enough. Plus the short-term debt is also 19,400. Okay, 19,440. Okay, let's get our receipt.
.8
For which year?
2021.
This
No,
one.
no. Okay, 2022.
How about
No,
this?
it's 3.8. 3.8. The first one is 3.8.
The first one is 3.6.
It's 3.
3.6. 3.6.
Okay, how about the second one?
$8.6.
8.6.
Approximately 8.7 is 8.67.
Okay. Then the next one is net asset turnover. I'm not sure I mentioned this. Can anyone guess what this formula can be? Net asset turnover.
Sales over net assets.
Yeah, that's perfectly correct. That's perfectly correct. Charity. Sales over net assets. And net asset is mostly the same thing as your equity. Plus your sales is 154,000. Your equity, as we picked up there, is 192. That's your net asset. Here, the sales is 159,000. Your equity is 154,800. So, how many times?
is 0.8.
It's 8 times. What about in 2021?
3.6.
3.6. There is current ratio. Current ratio is current assets all upon what?
Current.
Current
All of our
liability.
current liabilities.
Good. What was our current assets in 2021 and in 2022? 15, that's 15,980. 15,980. What's current liabilities? 29,920. 15,980. 29,920. One 2021. 28,890. 23,960. 28,890. 23,960. So what's the ratio?
So I'm having 0.5.
0.5 ratio
Is
1.
0.5 to 1.
Yes. How about the second year?
1.2 to 1.
1.2 ratio 1. Then the next one is interest cover. Which is your profit, your PBIT, which is profit from operations, divided by finance costs. Now what's profit
I
from operations?
payable.
Sorry?
PBIT over interest payable.
Are we just written the same thing?
It's the same thing as finance cost now.
Yeah, you need to know all of these things so that simple things will not throw you off balance in the exam. What was my finance costs? 9210. What's my finance cost? What am I doing? 92. What was my profit from operations? Okay, yeah, I was correct. 12.3. 86. Okay, so how many times?
1.3.
How about this other year?
Is 0.84.
No, 1.8 times.
No, cannot be.
The operating profit is 18,600, not 86.
That means, okay, 18,600. So you
So
say it's
it's
1.1?
8 times.
8 times. What's the final one? Gearing. And they told us that we should use gearing as debt to equity. So debt over equity times 100, of course. And our debt, where did we use debt? Okay, this debt here. Over equity. This is equity. Times 100. And the second one, where's my debt? So what's the answer to this?
So, have you considered that? I think the question said loan notes should be considered as debt. I don't know whether we have considered that.
Yes, which is why I added both short and long term.
Okay, yes, okay, thank
That's
you.
what it meant. Yeah.
Hello, sir.
Yes.
Please, I want to need a clarification. No, there's a debt ratio, there's Jerry ratio.
Yeah.
This Jerry is not supposed to be debt over equity plus debt, but you are using only equity, sir.
Yes, you can do that too.
Now, the
Especially
question.
when the question actually tells you that's what you should do. Look at it. The question told us that we should do debt over equity.
Okay. Another thing I don't know. Can we also use replacement as capital employed for that
For which one?
as the denominating factor?
What is capital employed? When you say you want to use capital employed, what is capital employed?
Uh, it's equity plus debt now.
So, and the examiner says use equity alone.
Okay. All right.
Okay, so how much are we looking at? Sleep.
Root. Hold on, my phone. 5%. Make I tell them soon.
Charity, you better mute.
Sorry, sir.
Yes, I'm outside. Yeah, there's really nothing you can do. Okay, so we have completed these ratios and we can go on and on. So this one, I'll send you a note on these comments on how you can comment on their position and performance. So you will see that basically when you're commenting, You will be commenting based on the ratios that you computed. You'll be comparing 2021 to 2022, telling the examiner whether this company is doing well. Of course, they are not doing well at all because all profitability ratios are declining. All liquidity ratios are declining. Except gearing, which is okay. This is very okay to decline. Interest cover declining, current ratio declining, net assets turnover declining, return on equity declining, operating profit margin declining. This is not good. So I'm going to paste the comments here for you to read before I would paste it for you. So their revenue is also declining. Yeah, what about their cash position declining? I mean, this is not a good company. So, yeah, so that's just it. Now, I'll allow you go for tonight. We would be looking at IFRS 18 together. I just want to tell you a few things around IFRS 18 that you need to know. I think that's the only thing that's left. And for the FR guys, I'll be doing, for those that are interested, I'll be doing a revision class. A 2 days revision class is more like an intensive. I want to revise everything that I've taught you so far on the assumption that you have read everything. So I'll pick PPE, I will revise it. It's just an high-level summary, just to revise everything that we have done and touch on. So that's what we'll do for the first day. We'll look at the principles in every standard that I taught you, group, everything. I'll just touch on everything. Then the next day, we'll then solve past questions. Key questions. We can pick one, solve one additional question on cash flow, solve one question on ratio again, solve one question on standard. We just pick questions here and there. So 2 days. Then next week, I'll do the same thing for SBR, revise everything I've taught you so far. On the assumption that you have read everything, because you should have read everything, but it's just like a recap. It's just for you to listen, use it to refresh, and it will be fresh in your mind. So nothing is going to shock you in the exam. And most of the past questions I will give you, which is why I didn't bother myself sending you any mock question. I'm not going to send you any mock questions. So I'll probably use the what's it called? What's this question? These are pilots. So for these are intensive, that's majorly where I will focus on for the intensive. So I would then use that as revision. Then we can then move from there to whatever. But that's basically where the intensive is going to really focus on. Again, is assuming that you have really read like on your own as many things as you can. So we'll do that for you guys. So most likely, for the SBR guys, there's this portion of foreign subsidiary. There's this question I did not finish. I think we can just quickly round up that question within 30 minutes. It won't even take 30 minutes. So probably we can do that maybe tomorrow, just 30 minutes to round up that. Then maybe next tomorrow we can look at IFRS 18. I don't think it won't be a long class, maybe 1 hour or less. Because I just want to look at the new things that they introduce, what you should know. So we'll do that on next to be 1 hour or less for us to do that. So If you wish, those that are in SBR, we can also join the first day FR intensive, because the assumption for you guys doing SBR is this, that you must know everything in FR fresh, all those standards, they want you to know everything. So I would advise you to join their own self so that you can use that as a refresher. It's even good for you. Just join. So that will just be your revision. You just be noting down all the small things. You just, and whatever it is you get from there, it's surely going to help in the exam at the end of the day. So just keep reading and you just keep revising. I mean, I don't really leave my students till they go and write the exams. So it's just a way of keeping you focused, and I'll be expecting you to now be asking very constructive questions, showing me that you're actually reading, because you have done a lot. You have done everything that you need to pass, because the pass mark is 50. So you have no reason to get less than 70. Worst case in the exam, because you have all the resources. But we'll keep pushing until you go in, write the exams, then you do well. Okay, I'll stop here for tonight. Mr. Christopher, you want to mention something?
Yes. When in course of I think at the exception of trying to introduce this course, we mentioned limitations of EPS. And findings indicate that anytime EPS question, especially as a theory is being set by ICAN, they must ask that question. Sometimes your explanation here can even guide us to the exam without even us not going through. So I don't want, if by any way you can help us to simplify those limitations with an illustration so that we can just grab it once and for all and get it done.
Yeah. So very good one, Mr. Christopher. So remember that earnings per share looks at the profits that is attributable to ordinary shares, the earnings attributable to ordinary shares. So for each of the shares they have, what is their earnings? Right? It's a good ratio that you use to measure how profitable a company is and the return the company is giving to shareholders. It's fantastic, but it has limitations, right? So number one is it does not take into consideration cash flows. Like I mentioned earlier, you are saying that a company with high EPS is good, but does it have money? Does it have cash? You are parading an EPS of 2 naira or 10 naira or 20 naira. Does it have cash? So one of the downside or limitation of earnings per share is that it does not take into consideration the cash flows involved in settling those earnings. It's one limitation. Another limitation is that this EPS does not separate, it does not distinguish between a large company and a small company. So it can mislead investor. It does not distinguish between a large, because eh, depending on, because we are talking about relativity here, comparing profits to number of shares. So two companies might be having 2 naira, another one having 2 naira. They are not the same company. You can do EPS of Dangote and it's doing 3 naira. You can do EPS of a sole trader and the guy, you would find that his EPS is around the same thing. That doesn't mean they are the same company. So it's a limitation, that the fact that it doesn't distinguish small company from large company, it is a limitation. It is a limitation. Another one is that the EPS figures can easily be affected by inflation. So when you do your computations and you are in an hyperinflationary environment where prices are high, it can distort the EPS figures. So it is a limitation of EPS as it were. And also, EPS can easily be affected by the accounting policy choice of an organization. So, because accounting policy that you choose can seriously impact your profits. So whatever ratio you compute would be impacted. So EPS can also impact, or the accounting policy choice of a company can impact whatever figure that you compute as EPS. So ultimately, EPS has a limitation in the sense that, yes, it measures profitability, but it does not give us the complete position or complete performance vis-a-vis the company's liquidity. It doesn't give us a complete reflection of the company's performance. It does not. And also is that the computation of EPS using weighted average number of shares as the denominator can also, it makes computation of EPS complex. It could become complex. Like the assignment I gave you when I taught you EPS over the weekend, I gave you one assignment. Only a few of you, like 2 or 3 of you did it, and I shared the solution. It can become very complex. At times, when you want to compute something like diluted EPS, okay, when you want to compute that, so the computation can become overly complex like that. And a lot of other limitations that, at least from all I've mentioned, you should be able to pick minimum of 4 for your exams. But hopefully, when we are doing our intensive, hopefully we would pick, I would say, especially for the XBR, for your revision intensive class, very importantly, I will solve at least, we'll revise like 2 more questions on ratio that will look at the one in the Pint Finder, I said Pint Finder, in your pilot question, and one other one, the one of last diet as well. We'll use those ones as intensive questions for us before we move to other areas. But basically, so that's it for limitations of EPS. Okay, so let's go and rest. I would update you guys as we move on. Thank you very much.
Thank you, sir.
Thank you, sir. Good night.
Good night.